I appreciate you taking the time to watch this video and hope you're all doing okay out there. And this video, I want to talk about fast moving averages. Now, moving averages, they can come in as many lengths as you could think of, right? But at the very basic level, you're going to look at short-term, medium-term, and longer-term moving averages. And here's just a list of some of the more popular average settings. And a 9-period SMA is going to react faster to a price change than a 50 or 100-period average. When we start talking about exponential moving averages, the EMA, we're going to see price react a little quicker than the simple average, just due to the way it's calculated. For a simple moving average, the calculation is very simple. You just add up the last N period of closing prices and then divide by N. So if I was using a 5-period SMA, I'm going to add up the previous 5 closes, divide it by 5. It's going to give me an average closing price. And the next period, the next day, you would just drop the first 5 in the equation, right? Because we're just using a standard average calculation. Exponential moving averages, they place more importance on recent price, right, than the previous price points. So this feature allows the same period as the SMA to react quicker to price movements. You see on this chart here, it's the same period setting for the SMA and the EMA, but you can see the EMA moves a little bit quicker. Here's the formula for an EMA, and that's not all of it. You still need to figure out what K is, and that has its own calculation. So if I was using a 10-period EMA, as you saw in the chart, the calculation would look like this. Right? All that means is that a 10-period EMA would weight the most recent price by 18% more, giving it a faster reaction time. That's it. So should a moving average type, an SMA or EMA, should it matter enough to take a losing trade into a winning trade strategy? No, not really. Just pick an average and just use that. And this is always interesting. You hear a lot of people say, well, institutions use a 50-day moving average. Well, the truth is, I've never seen any quantifiable data to prove that that's what institutions even use. Now, so that insight, if you can even call it an insight, that's just been passed down for generations and generations of traders. Who knows what they use? It's because one doesn't mean they all do. Just question the validity of statements like that, those generalized statements. You could generally come up with your own answer of how that may or may not make sense. Anyways, back to the averages. The one feature I like about a fast moving average and using only the simple moving average formula is I can see a strong move in price, but I can also see consolidation easier. So when I use a strong move in price, seeing how far price is away from the fast moving average, and then looking for consolidations for a continuation trade, very viable trading approach. And in fact, it's my preferred approach to trading. Now let's talk about this. And I know we've all heard that moving averages are dynamic support and resistance, and it appears that way at times, but all you're seeing is the moving average catching up to price. Look, in the middle of the chart here, the closing price of each candle on average over 10 periods using an SMA, it's not really rising. Right? Price is ranging sideways as that moving average can then catch up to sideways price because the average closing price is not getting bigger. The 20-period SMA, that's the black line, that continues to rise, but remember, it's just the average close over 20 periods. The red line shows the approximate middle of the range, right? The average area. Now, I know some will say, hey, look, that 20 SMA actually had the candle's low bounce right off of it. That proves its support. Did it really do that? Moving averages only finish plotting on the close of the period, right? The moving average closing price is unknown until the period closes. And a higher closing price on the candle will pull up the average further. The only known value when that large white candle was forming was the previous candle and the price of the average on that date, right? So if it was acting as support, it would have had to have bounced from that price from the day before. The faster the moving average, the faster it's going to meet with consolidating price action. Now, once price makes a strong move in one direction, it's normal for price to pause, right? It's during those pauses and the subsequent breakout, that's the time to get involved for a potential move in the same direction. So one good use of a moving average is to look for price and the moving average to meet up. So there's validity with the rule of thumb about using moving averages only with trending markets. Okay, but we also can't forget how great they are in showing us a market in consolidation, right? And it can also give us a period of time it's consolidated for. This is a daily chart of JXN. Okay, I started trading it near the tail end of 2021. We had a fairly large run-up in price of 34%, right? That puts it on the radar. You can see prices peeled away from the fast-moving average, right? The blue line. Now, after a big move up, we need to see some consolidation. And I like to see price and the moving average. It doesn't matter. It could be a 10, a 20, a 15, a 6. It doesn't matter. I want to see it start to mingle with price. I just use 10 and 20. Because without some type of consolidation, you could actually end up buying the high print only to see a sharp reversal against you. So when I see a consolidation, I know at a glance this price has not put in a large move since that run up. This means I also know that it's consolidated for a few days once those moving averages meet price. This is a simple chart pattern, simple trade entries. It's a bull flag. Trade is entered after a strong close outside the upper trend line, or you could use an opening range breakout. And number two, that's just a sideways consolidation and a failure test of the lows of the range. I like these as an early entry when price breaks the high of the reversal on the next day because you're into this trade before it breaks out. Now listen, I'm not trading the average as support or resistance, okay? I'm just trading the chart pattern. I'm using the averages as a measuring stick for the consolidation. So how long for the consolidation? Well, I want to see at least a touch of a moving average and then a chart pattern that I can trade. I also want to see the patterns begin to form high up on the impulse move. I want to see there's interest in the instrument. And if we get a strong sell-off after a big move, the odds are going to decrease on a successful trade or even a long-running trade if it does start to break out. Because once I see momentum to the downside when I'm looking for a long trade, I just hold off trading the instrument to the long side. That's my own personal standard rule for trading any pullback in price, right? Strong momentum in the opposite direction, I'm not a fan of. Now, this is going to be an example from ATKR about failed chart patterns. And it's a good example of using the whipsaw motion of price around the averages, right? So when you see price whipping around the averages, you're looking at some choppy price action. Dangerous to trade. But inside of that whippy price action, right, patterns will begin to form. In this case, it was a triangle. Now, price had made a strong run up, began to consolidate high up on that impulse move. Now, a triangle is just not a make-believe pattern, right? I want to see at least 4 obvious points. The first point's going to be the high of the move. The second point's going to be the pullback in price. The third point is just a move to the upside that puts in a lower high. The fourth move is going to be a move to the downside that puts in a higher low. The dashed line here, though, that shows where the triangle pattern actually failed. But keep in mind, the context is still bullish due to that big move up and the consolidation near the high of the move. And really, there's no strong momentum to the downside. We get a failure test of support. Price is bought up. Price then made a 20% jump from that zone, and it did quickly roll over. So this pattern eventually became more of a sideways trading range. You would have seen it better on the weekly chart after that run up there and where the price rolled over. But the key is don't give up on the pattern that you're looking at if it fails, because this triangle turned into a support holding setup. I had a failure test of the lows for an entry, led to a $15 jump in the price of the stock. Now, if price had broken down further, I would have needed to see another strong move in price before finding interest in trading this again. We're going to look at a chart called Plug. And so watching the next move, which is the next impulse swing. So the first move up is a 42% jump in price. We see price consolidating near the high of the move, begins to meet up with the 10 SMA. So you can see resistance holding, right? Price is essentially making higher lows into resistance. And if you watch the video about trading breakouts, you're going to note that price basing under resistance I talk about as being generally bullish. But here's the issue with this chart. That next move up was almost half of the first one. Swing analysis would tell you that buying was drying up at these higher prices. So the red lines here, they're going to indicate moves that you want to be aware of, okay? This is a corrective move, and you can see it's deeper than the first one. That means more traders either took profits or you saw sellers entering the market. We get a big move up, we get a shallow pullback, that's really good. But then the impulse move is shorter than the previous ones. This is going to show either a lack of buying interest, maybe some profit taking, or we see sellers starting to enter the market. If we go back to the trading chart, I began to see the formation of a triangle. But that quickly fell apart when we got a new candle low into support. I also didn't get a failure test of the lows below support. No trade entry. So given the lack of strong movement to the upside, right, that led to the consolidation, I got to see a quality setup taking place. And in this case, we didn't. It was really sloppy. So I want you to notice that all of these setups are only considered after enough price action and time was taken, right, to have that moving averages catch up to price. These patterns are tight. When you trade consolidations, time can be an important factor because generally, the longer the consolidation, within reason, obviously, the longer it is, the bigger the breakout's going to be. We can wrap this up here. Moving averages, they have their use. And this fast moving average, it can be an important tool for any trader. When you see price pull away from a short-term average, such as the 10 SMA, it shows strength in that current move. Right? We're seeing, on average, higher closing prices. And even better, the bigger the daily range is, the more price is going to pull away from the average. We let price settle into consolidation, where the moving averages get closer to the price, gives us the benefit of time in the pattern. You want to have a few different entry techniques to use. Trendline breaks, failure tests, opening range breakouts. It's just simply strong closes beyond a level. Now, I didn't go over exits and protective stops, but you can keep those simple as well, right? An ATR for your stop at the average true range. You can even use the low of the day that you enter. Profit targets, use a previous swing high or low for trade management. You can use multiples of your risk. There's different ways to do it. But whatever pattern or whatever moving average you're using, you got to make sure this is all written down in a trading plan. Make sure you hit like, subscribe to this video. Any questions, pop them below. I'll get back to you. Thanks for watching.